who's buying a lot of gold right now?
The Chinese central bank.
Yeah, this Chinese central bank. That's one reason that that precious metal is not depressed. By the way, Andy, it's in a bull market, and it's going to stay in a bull market because you have quite a bit of central bank buying, and other even private consumption or buying of gold in China is very heavy.
Hi, all. I usually don't do this, but I have an extra special guest on today. It is Professor Steve Hanke, who is one of my heroes. He is a professor of applied economics and the founder and co-director of the Institute of Applied Economics, Global Health, and the study of business enterprises at the Johns Hopkins University in Baltimore. He is also a senior fellow at the Independent Institute in Oakland, California, a senior advisor at the Redmond University of China's International Monetary Research Institute in Beijing, and a special counselor to the Center of Financial Stability in New York. Dr. Hanke.
All right, Andy, great to be with you.
It is an absolute honor. I have been a trader and investor all of my life. I remember you from, I want to say nearly 30 years ago, and I'm finally getting to talk to you. So it's just fantastic. I would like to jump in on this just really quick, not really quick, but then take a deep dive into the world markets and commodities. But we just had an election here recently, probably heard about it. And I wanted to see, has this changed anything specifically with the confirmation of the new Treasury Secretary Scott Besant?
Well, it's changed a lot of things. Just a headliner would be that the global corporate income tax that Secretary Yellen was pushing under the Biden administration is ancient history. Fortunately, I mean, if you can believe it, the Biden administration and the former Secretary of Treasury were going to give up U.S. sovereignty. In other words, globally, our taxes would be decided. The U.S. wouldn't even be deciding them. So, as a matter of principle, it was, I would say, a reckless policy position. Now, speaking of sovereignty, of course, there's another thing the new Secretary of Treasury won't be directly involved in, but certainly the President Trump is, and that is reclaiming sovereignty of the borders of the United States. Now sovereignty, according to the great French diplomat Talleyrand, sovereignty is equivalent to the notion of private property in the private sphere. So you have to establish rules that govern your borders, and that's clearly what Trump has in mind. Exactly how they're going to do that, how they're going to get rid of all the illegals that are here illegally, is something we'll have to stay tuned with. But as a matter of principle, that's a very important thing. So you have two issues of directly related to sovereignty that are big headliners. We're not going to have global taxes in the United States dictated by some alliance or configuration of foreign countries. We'll determine our own taxes in the United States. So that's out. We got bye on that one, and bye Biden on what was really a completely reckless policy of opening the borders in the United States and allowing people to literally illegally enter the country and encouraging them, not only letting them, but inviting, encouraging them. And by the way, who was facilitating a lot of this? The criminal gangs and cartels in Mexico, as well as Colombia and Venezuela, were making big time money. Now, the question I have that is no one seems to want to address: how do these illegals come up with $5,000 or $10,000 or maybe even more than that to come into the country. I mean, they're coming supposedly because they're impoverished, coming from poor countries. They have no money. And you can see them coming across. I mean, they're all decked out in pretty decent clothing. All of them, of course, have iPhones. So it's kind of curious what's going on. It's not really curious to me. Know very well what's going on. There's a lot of money being funneled into the cartels and that money is not coming from those impoverished illegals coming across the border. It's coming from NGOs, churches, or other other entities are supplying, hundreds of millions of dollars to flood the flood the zone, and the zone happens to be the United States. As as they say in sports, flood the zone. Speaking of flooding the zone, Trump clearly did flood the zone with these executive orders, and the Democrats are, completely at a loss of what to do.
Yeah, no, it really is. And it's interesting too. I don't know if you've got so much pushback on this, but he designated the cartels. He brought up the cartels as terrorist organizations. So I thought that was interesting. And people, I don't want to say they pushed back, but it surprised a lot of people what I found. Why would it even surprise you when that's more or less what they're doing?
Yeah, well, they all. I mean, there, there have been a lot of groups that have been designated as terrorist organizations that are a lot less lethal than the gangs in Mexico and Latin America in general. So that's one point. The other point that I think is important to realize is that the the cartels in Mexico essentially run Mexico. So the idea that it's a smooth functioning uh, democratic republic uh, is a little bit foolish. If you look under the hood, the cartels run vast swaths of Mexico and have a great deal of influence, obviously, over the judiciary and all sorts of other things. And so it's not just a bunch of gangsters running around ripping people off and murdering people. It's they're into the political infrastructure of Mexico. And by the way, my guess is, although I haven't talked to Trump directly or anyone close to Trump, but my guess is his one reason he's taking a little bit of, shall we say, an aggressive line against Mexico. That's part of the picture.
Yeah, no, I think so. I would agree 100% with you. Um, let's play that out really for the rest of the world here. What does this exactly mean with national sovereignty? We're obviously reestablishing borders. What does that mean for really, yes, our trading partners with the rest of the world? And how does this impact really inflation or deflation, if you would?
Well, the one thing that is coming along with the establishment of sovereignty is a much more nationalistic approach. So it's a form of nationalism that's coming along with it. Now that it, in principle can be fine, but it depends on how you actually implement and utilize that kind of ideology. And one thing I'm very opposed to is the idea of tariffs, sanctions. I'm against sanctions of all kinds. I'm against tariffs. I'm against quotas. I'm against non-tariff barriers. And Trump is clearly he has many ideas that are conflicting and contradictory that he throws around. But one thing that is pretty clear is that Trump is an old fashioned mercantilist. That's the form nationalism that is in the economic sphere. Now, if you're a mercantilist, of course, you've never seen a tariff that you didn't like, or a quota that you didn't like, or a non-tariff barrier that you didn't like, and that's all bad news, because that will reduce those policies, those protectionist policies, will reduce the purchasing power of Americans, and be bad. I mean, the benefits don't outweigh the cost. The cost outweigh the benefits. So I think this is a very bad turn, and I'm totally opposed to it. See, many businessmen, by the way, have this kind of mercantilist idea, and the reason they have it, they're thinking in terms not of a nation or nationalistic or anything, or sovereignty or anything like that. They're thinking about a business, and a business for them makes a profit when the revenues coming in are greater than the costs going out. And they view the country the same way. So they view, for example, a trade deficit or a current account deficit, international imbalances, shall we say, as being bad unless they're a surplus. A surplus is good because that's like a business. That's they view that as making a profit. But deficits are bad. Now, that's just nonsense, because there's a basic identity in economics. Savings equal investment is the identity. And if savings is less than investment and you have a savings deficiency in the economy, what happens? You must run a trade and current account deficit. And that's what the United States has done since 1975. We have a savings deficiency in the United States. And the deficiency, if you look at all the components, the deficiency is almost exactly equal to the federal deficit. That's where the deficiency comes in, because the federal government, what? They take in less money than they spend. They run a fiscal deficit. And that is a savings deficiency. And it turns out that it's almost exactly equal to the trade deficit. The trade deficit's caused by that. And so what are we getting at here? The trade imbalances are always caused domestically. They're not caused by foreigners subsidizing companies, by foreigners manipulating their exchange rates to get them down to artificially low levels or anything like that. They're homegrown. They're caused at home. Why do you think China has such a massive trade surplus? Because they have a massive savings excess. People save a lot, huge amount in China. And the reason they do, there's virtually no safety net for retirement or anything like that that's provided by the government. So the Chinese save a lot for their old age. They want something in the cookie jar they can get into when they get old and stop working. So they out of their income, they don't consume too much. They save a lot. And that's why they have huge surpluses. Switzerland has huge savings surpluses. They have a trade surplus. Germany, traditionally, they save a lot. They have trade surpluses. The US doesn't. And by the way, the US doesn't. And they can easily finance it because the US dollar is the international currency and they can finance it cheaply. So I'm not saying deficits or surpluses are bad, by the way. I'm just neutral on those imbalances. What I am saying is that they're caused domestically. They have nothing to do with anything international. So if you're reading the press, it's all wrong. It follows Hanke's 95% rule. 95% of what you read in the press is either wrong or irrelevant.
So let's again bring it back to does this mean today with you see Trump's new policy, or really his new Treasury Secretary's new policy? Because he's on record about talking about deficits, how deficits matter, if you would. Is that going to be deflationary here? Do you see that going into 25, or are we going to still live in monetary inflation?
Well, none of these policies will. What will the policies do? They'll affect the relative prices of certain things. Certain things will go up or go down relative to other to the basket, shall we say, of the consumer price index, which includes over 300 items. But inflation is always caused by substantial changes in the money supply.
Right.
So inflation has nothing to do with these policies. They have it all wrong. Press has all this wrong. And even the Trump administration, by the way, and the new Secretary of Treasury has bought into this idea that somehow these tariffs and deregulation and extension of those tax cuts that were put in place in Trump's first term, if they renew those and extend them permanently, which would be a good idea, by the way, that somehow all that's going to be inflationary. No, it has nothing to do with inflation. What the Fed does and what the monetary policies do and bank regulations that affect the supply of money, that is what causes inflation. I have never known a substantial inflation any place in the world. That's an inflation of 4% or more lasting for 2 years or more that hasn't been preceded by a substantial increase in the money supply. It's all about the money supply. Well, no one looks at the money supply anymore. No one has learned what the quantity theory of money is and monetarism is. But if you think about it, what's the fuel for the economy? What causes nominal GDP to change? It's changes in the money supply. And nominal GDP, by the way, has two components in it. If the real rate of growth in the economy, and you add to that the inflation rate, and that is nominal GDP. So the model, the only reliable model for national income determination, which is the course of nominal GDP, is the quantity theory of money. It's been around since the 16th century. But the last 30 years, post-Keynesian economics has been taught at universities, and those post-Keynesian models, they don't even include an aggregate for the money supply. They don't even include that variable.
Yeah, I remember that actually, meaning I was discussing this over with friends about how they're trying to get rid of, I want to say this correctly, how it's hard to find metrics on the market supply. Because if you know what I'm saying, it was just
No,
hard.
they don't even. It is hard to find. This is not a headline thing they report in the newspapers. They report the Fed funds rate and the interest rate and what the Fed is going to be doing with the Fed funds rate. But remember, monetary policy is not about changes in interest rates. It's about changes in the money supply.
Right. Right.
And by the way, when you change the money supply, what happens? Let's go back to February 2020. That was, remember, the pandemic, the COVID pandemic. And what did the Fed do? It started goosing the money supply right away, and it went up at its peak. It was growing 17% year over year. That's the highest rate the money supply has ever grown in the United States. So as you have a substantial increase in the money supply, the next thing that happens with a lag, asset prices change. Well, what happened? The stock market boom, real estate prices boom, land values boom. And then the next thing that happens with another lag is changes in real economic activity, real growth. And we had a boom in real economic activity. And then the last thing in the transmission mechanism after these changes in the money supply, you get changes in inflation. Well, we got changes in inflation. And it turns out, by the way, that Who who anticipated exactly where the inflation was going? Well, John Greenwood and I did that by applying the quantity theory of money. We said that the inflation would go up to 9% year over year. It went up, it peaked at 9.1% year over year. So that's the name of the game is money and changes in the money supply. People don't look at that, Andy. They look at current data that are coming out every day, and they pay a lot of attention to that, and the zigs and zags and those daily inflation, interest rates, or whatever they happen to be looking at, and what causes those daily changes? What causes the daily changes is what happened to the money supply a year ago, 2 years ago, 3 years ago. They're not looking at that. They don't even understand that there is a significant causal relationship with lags between changes in the money supply and changes in all these economic variables that they're looking at.
Well, that begs the question then, or leads me to then, where is the money supply currently, and here in the U.S., and how can we can make a projection off of that then?
Well, the money supply, the stock of money since July of 2022 is actually a little bit lower than it was in the summer of 2022. Now, that's only happened 4 times since the Fed was established in 1913. And every one of those contractions has been followed by a recession, or in one case, the huge contraction that we had 1929 to 1933, the money supply contracted by 38%, massive. We had a Great Depression, of course. The other ones were just followed by, garden variety recession. So that kind of sets the stage a little bit. And then if you look at more current data, the growth rate, the money supply is a little over 3%, almost 4% year over year right now. But that is below Hanke's golden growth rate of 6%, a rate that's consistent with hitting the Fed's inflation target of 2%. So we not only have this stock that's contracted, but it's the current growth rate, or year over year growth rate, is still submerged and anemic relative to where it should be if the Fed wanted to hit its 2% inflation target. So that means what? It means that more reductions in the headline CPI are on the horizon. We'll get this year, probably some readings even below the 2% inflation target of the Fed. And that has implications in the market because the yields on bonds follow inflation. So if inflation's coming down, the yields on bonds aren't going to go up. Now the consensus is, they're going to go up. We're going to have more inflation. All this Trump policy stuff is inflationary. No, they got it all wrong. Trump's policies aren't inflationary. Number one, they do change relative prices. If you put tariffs on things, imports, the prices of those imports are going to go up relative to other prices. And that means the cost to final consumers that buy some of those imports will go up. A lot of goods that go into places like Walmart and so forth, those imports will go up. It'll also increase the cost inputs that go up into manufacturing processes that use imports. So it comes in two ways. Some of these imports are finished goods that go to final consumers, the folks who go to Walmart and so forth, or other retail outlets, not just Walmart. It also affects intermediate prices of inputs that go into production process, and that will increase the cost of producing things that are using those inputs. So those are all relative price changes, but they're not inflation. inflation is an aggregate that that looks at a lot of goods and services. By the way, goods and services, not just goods, and aggregates those up, and that aggregation, whether it's a producer price index, consumer price index, whatever index, or lots of price indexes that we look at, those are all driven by changes in the money supply.
So what does this actually mean then for our nationalism? Is That's what I want to know then, is like more money, since the money supply, for what you're saying, please correct me if I'm wrong. If it's contracting a little bit, it's not keeping up with the rate of growth at 6% that we need, from what you just said. And please correct me if I'm misphrasing you or misquoting you. What does that mean really for the rest of the world, since we're buying their products? Yeah.
Well, it means eventually one thing that's baked in the cake. There are two things that are baked in the cake. Look
Yeah.
at the two. Look at what money supply affects nominal GDP, and nominal GDP has a real component and an inflation component. And what it means is that it takes their long and variable lag between the changes in the money supply and changes in nominal GDP. So it means that we'll probably see a slowdown in the economy this year, and we'll see a continued slowdown in the price level. That's what it means. And in market terms, it means that interest rates on long bonds, for example, always follow changes in inflation. So those yields will come down, meaning the price of the bonds will go up. The 10-year bond price will go up and the yield will come down. That's what's going on.
That's what theory I have. I think.
And the nationalism thing, it depends on what aspects of these tariffs or tariff threats, and so how that all worked out, which is uh, a complicated process, and obviously country by country, commodity by commodity, import by import.
Professor Hanke, could
Yeah.
you tell me about, how you think the tariffs are going to affect prices in the short term? You also mentioned intermediate, but long term, does the administration see that benefiting the U.S. employment, U.S. jobs, kind of like forcing them to kind of build companies inside the country as opposed to down in Mexico or something like that?
I think it's just negative right across the board. The idea that these things increase jobs is just absolute nonsense, because let's go back to an episode before. Now the big enemy is China, because China, we have a trade deficit, and we have a trade deficit because we don't save enough. That's given. The question is, who's filling the deficit? And now China is the main one filling it. It was when I was on Reagan's Council of Economic Advisors in the early 80s, who was filling the deficit? It wasn't China. It was Japan. Japan was the enemy. And so what happened? Reagan was a free trader like me, and like the at the time, the people on the Council of Economic Advisors, and the people in the U.S. Treasury, and the people at OMB. David Stockman was heading OMB at the time. So you, and Reagan. So you had that phalanx of free traders that didn't like tariffs, didn't like quotas, didn't like non-tariff barriers. But in the Department of Commerce, you had Secretary Baldrige, and on Capitol Hill, you had other people that were mercantilists, thinking about protectionism. And so the record was kind of a mixed bag under Reagan, but one aspect of it did deal with Japan. And what was that aspect? It was basically a quota, voluntary restraints that the Japanese agreed to. The Japanese said, we're not going to send you as many cars. We're going to put a quota on the number of Japanese cars that come into the United States. And the Japanese were very smart, actually. They did limit the number of cars coming into the United States. But what they did, they reduced the overall number they were sending in so they could meet the new voluntary restraint quota. But they only sent expensive Toyotas and Lexus and cars where they made big fat margins. So it didn't hurt the Japanese at all. Actually, it turned out to be a good deal for the Japanese in a way. But did it create jobs? Yes, jobs. No. Manufacturing jobs have been going down, down, down in the United States for many years. And the reason and the output of manufacturing is going up. So manufacturing goes up, up, up. The jobs go down, down, down. You're not creating any new jobs, but manufacturing is doing very well in the United States. Thank you. And the reason for that's technical change, which increases productivity and output per hour of worker in the United States. So it's just a fool's errand to send somebody off with tariffs saying you're going to increase jobs. It doesn't work. It doesn't happen. And the Japanese case that I just gave you is one thing. It didn't really produce any jobs in the United States or increase employment and manufacturing. Employment and manufacturing just kept going down, or out kept going up.
Professor Hanke, if we could pivot a little bit, I'd like to discuss China and the slowdown in China. If you could talk about that and really what the expectation, or you see why and what the expectation is going forward. And really, correct me if I'm wrong, I believe that's the primary engine, if you would, to the commodities market in the last probably 20 plus years. What does that really mean, the slowdown mean for commodities? And do you see a bottom here in commodity prices, which seem to be relatively depressed?
So, well, you're right. I mean, the elephant in the room in the commodity, a lot of the commodity markets is China. Whether it's agricultural commodities or base metals or by the way, even precious metals. Who's buying a lot of gold right now?
The Chinese central bank.
Yeah, this Chinese central bank. That's one reason that precious metal is not depressed. By the way, Andy, it's in a bull market, and it's going to stay in a bull market because you have quite a bit of central bank buying and other. Even private consumption or buying of gold in China is very heavy. So the macroeconomic picture, you have to look again at what's the model for national income determination. That's a quantity theory of money. What's Hanke's golden growth rate for the quantity of money growth in China? It's about 11% per year. And right now, money supply is growing at about 7.3%. It's very depressed. It's not growing very fast. And what's the CPI? By the way, the 11% golden growth rate is a rate consistent with hitting China's inflation target of 3%. That's but what is their actual inflation? It's zero. Why is it zero? Because the rate of growth in the money supply is 7.3% year over year. And the rate, Hanke's golden growth rate, consistent with hitting a 3% inflation target, is 11. It's a simple game. And the Chinese have said that the Politburo late last year said they're going to start stimulating the economy. We don't know exactly how they're going to do that. My guess is that they're not keeping their eye on the money supply correctly. they've kind of changed. They used to watch the money supply and follow it pretty carefully, but I think they are probably going to engage in a lot of fiscal stimulus, and that's not the way to do it. The fiscal stimulus won't stimulate anything because money dominates. And to get a handle on what do I mean by money dominates? Money dominates over fiscal. All you have to do is look at Japan. Japan, the rate of growth over the last 30 years and the money supply has been totally anemic. And of course, they don't have much of inflation. It's popped up the latest data. But if you look over the last 30 years since 1990, there's been a way below target, no inflation whatsoever. But the money supply has been growing way below Hanke's golden growth rate. And what about the fiscal deficit? The fiscal deficit has exploded. Debt to GDP, it's like 250 or 60%. The ratio, I can't remember exactly what it is, but it's a huge deficit that they've run. But they haven't had any inflation because money dominates. Money dominates. Money's been growing very slowly in Japan, and that's why Japan has no inflation. That's why Japan's had very slow growth for the last 30 years, and it has been dead in the water. And so I think that China could very well get into kind of a Japanese trap.
How do they avoid that, if you would? Then?
Well, they can avoid it by getting the money supply growth up to around 11% per year. They should be focusing on the rate of growth in the money supply, paying attention to that. It's all about the money supply. These broad macroeconomic things are usually dominated by the money supply.
Okay, so then let's game that out then with money supply contracting, if you would, or being, in China as well as Japan, and also falling in the US here. What does that mean for specifically oil? Talk to me about that. And there's also so much going on with oil. You got geopolitical events, you have supply and demand issues, if you would, but is that all related to the money supply as well? The price of oil?
Well, yeah, but let's now get in. Remember, Andy, you said you noticed me trading commodities some 30 years ago. Actually, it's more like the first really big trade I made was the Friedberg Mercantile Group, where I developed a little model for OPEC in late 1985 and concluded that OPEC was going to collapse. And oil prices, I said at the time, would go below $10 a barrel. They did.
Yeah.
And we had huge short positions. We had about 70% of the short interest in the London market in oil. So we had massive positions, and we were short the Saudi Riyal and Kuwait dinar too. But so
Well done.
I've been around the oil market for a while. As they say, I've been at that rodeo before. So what's going on? You have to view it just as a simple supply and demand kind of thing, and it looks like the number one, OPEC has quite a bit of excess capacity. So that's one factor. The other factor is that the increment in demand anticipated for 2025 is all going to be filled by an incremental increase in non-OPEC production. So my bias, and I think also that the crude oil demand in China, we were just talking about China, is probably peaked out. So that's kind of the picture, and that picture leaves you with what? I have a downward bias in oil. If of course many things can erupt, the war or something, the Iranians block the Strait of Hormuz or something like that. I'm not talking about that. I'm just talking about supply and demand. The basic fundamentals look to me like they are pointing towards weaker oil prices.
With all things being equal, a weaker.
All things being equal, as they say, ceteris paribus, we've got oil prices probably biased on the downward side.
Okay, so that also would be negative for, correct me if I'm wrong, industrial metals such as nickel, zinc, copper. Correct.
Picture changes a little bit because remember, I started this thing by saying OPEC has a huge amount of excess capacity. So, and you've got non-OPEC players filling the, accommodating the new demand that's coming in. So that's fine. Now, let's look at copper, for example. That's a base metal. My bias would be up, down. And it would be up because, for example, China is, as we go into the green zone, which China is big time, it requires a lot of copper. Or artificial intelligence and more energy use and
Right.
all of these things. There are a lot of things that put a plus in the demand for copper, and on the supply side, it takes a hell of a lot of time before you can open a copper mine and increase the incremental production. Now, remember, oil, that's not the case. We if OPEC turned it on, they could they could flood the zone with oil. That's not the case with copper. So my bias there would be up. If we go to soft commodities, again, it's supply and demand, supply and demand. Now we're getting demand, relative prices. Before, the monetary thing was aggregate price levels moving, a whole bunch of stuff moving up and down. You get into these commodity markets, they're all relative prices. Oil is a relative price thing, supply and demand. Copper, relative price thing, supply and demand. Soft commodities, cocoa, it's a huge short supply issue, and consumers of cocoa, Hershey's, and these outfits are scrambling around trying to get they're trying to get find supply, scrambling all over the place. So my price bias would be up. Live cattle, let's move to live cattle. That's supply and demand in the United States. Herds are shrinking. Supply is shrinking. So where's my bias? Well, it would be up. So iron and steel. Who's a big who's the elephant in the room? Well, it's China. And China's housing market, while it's kind of construction, kind of stabilized, it stopped sinking. It's not in any boom phase. And why do you use iron and steel in housing in these apartment buildings? Well, it's rebar. It's a demand for rebar is drives it. But my price bias is down.
Right.
So it depends on what commodity you're looking at, and commodities are just supply and demand. No, I'm not saying that the macroeconomic picture doesn't have something to do with supply and demand. It usually has. It does have something to do with demand. It doesn't have much to do with supply.
Got it. Okay, if you would, came out with a book I'd like to talk about real quickly here. And it really got into what's the most interesting thing to me. It really goes into capital theory.
Well, it's called Capital Interest and Waiting. Palgrave Macmillan put it out a couple months ago. My co-author was the great polymath Leland B. Yeager, who unfortunately met the Grim Reaper when he was 93. This year, it was his centennial year. If he was still with us, he'd be 100 years old. But the it is a book on capital theory, and capital theory is a very contentious field that all the high priests in economic theory have dealt with, grappled with all kinds of puzzles, problems, and so forth. Yeager and I think we wrestled most of it to the ground finally, but it's controversial because it deals with profits and and production and distribution of income. So it's all the key points for everything we've been talking about are dealt with in capital theory, and waiting is in the title because what waiting is never been really incorporated into capital theory properly, and what do we mean by waiting? Waiting means to defer some of your consumption. In other words, you receive income and you decide that you're not going to consume all your income, and you save some of it and you wait to receive a return. An interest rate is a price of waiting. You receive an interest rate for waiting to consume ultimately in the future, not in the present. And so you have, we talked about China before. Well, China does a lot of waiting. They probably do. They probably do. If anything, excess waiting. But given the institutional structure and so forth in China, they save a lot. They're thrifty. Saving is this thrift, so they're very thrifty. In Switzerland, they're very thrifty. In Germany, they're very thrifty. In Europe in general, by the way, they're not. They consume virtually everything that comes in. They're not very thrifty, and the reason for that are the welfare states. The cradle to grave takes care of everybody, and so they don't worry about thrift or saving. They save everything, and of course, this is one reason, by the way, that Europe invests so little and saves so little, and that's one reason that the U.S. is outpacing Europe in growth big time.
Yeah.
The reason for such slow growth in Europe is actually, if you read our book, you'd be able to figure it out why economies grow and why they grow slowly and so forth. So there's a lot in the book. We've got about 100 pages in there that tie in specifically to financial markets and monetary policy. So again, if you put up that link that Springer has on it, people can see what's in the book in more detail, chapter by chapter.
Excellent. If you could give your Twitter handle, I'm a follower, so people can reach out.
Oh yeah, that's big time. I've got 777,000 followers. I'm the third most influential economist according to Focus Economics in the world, and the handle is @Steve_Hanke.
I will put all of this in the show notes. Professor Hanke, it was just, I can't tell you an honor and pleasure it was in talking to you. Been a follower for decades, and admirer from afar. And I'm just very, very grateful for your time. I'd love to have you on again. We do both have a hard stop here. We have a company to interview, but I really wanted to make sure we fit you in. And I would, I just can't tell you what an honor it was.
Well, Andy, it was great to be with you. I look forward to visiting with you again in the future. Great to be with you. Thank you.
Thank you.
Professor Hanke.
Thank you.